What's up, real estate investors? In today's video, we're going to be breaking down depreciation recapture taxes, including what is depreciation recapture, how much taxes do you have to pay on it, and strategies to actually mitigate your exposure to depreciation recapture when you do sell your property. Before we dive into all of that, my name is Thomas Castelli, and I invite you to subscribe to our newsletter for more tax tips. You can find the link for that in the description to this video. Also, make sure to subscribe so you don't miss out on future tax savings videos. And if you have any questions or comments, drop me a comment in the comment section. I'm going to be answering as many questions as I can. Also, please do excuse the bland white background. I recently moved and still have to update the room for everybody here on YouTube to make it look nice and pretty. But the show must go on. And here we are. And without further ado, let's break down depreciation recapture. Okay, let's just start with a brief recap of what depreciation is. Okay, so when you buy a rental property, it's going to deteriorate over time, despite the fact that it might actually be appreciating in value. The building actually falls apart. We all know this, right? If you have an appliance, it's not going to last forever. One day the refrigerator is going to break down. The laundry section of your house, the washer and dryer, will eventually break, and you have to get it replaced or fixed, whatever the case is. So we know buildings actually fall apart over time, and that is what the depreciation expense is for. Depreciation is a non-cash expense that shows up on your profit and loss statement that actually reduces your taxable income, but it doesn't actually reduce your cash flow necessarily, okay? And some people look at depreciation as a loan because what happens is as you take your depreciation expense over the years that you own your property, the IRS will eventually want you to pay a tax on that depreciation when you sell. So some people do look at it as a loan, but there are ways to mitigate your exposure, and I'll be breaking those down later on in the video. All right, so let's get into the depreciation taxes. Okay, so there are three types of depreciation recapture. The first type is Section 1245. Section 1245 is from personal property. Think things like appliances and fixtures and certain types of carpeting, things like that. That's going to fall into this Section 1245 bucket. Now, Section 1245 or personal property is eligible for bonus depreciation, so you might actually be accelerating a good portion of or taking or increasing your depreciation, front loading it, if you will, in the initial years you own your property. But with Section 1245, it's taxed at your ordinary income rates, which under current law is up to 37%. So that's how much you could be paying on your Section 1245 recapture. Now we're moving into Section 1250 recapture. Section 1250 recapture is from essentially land improvements for our intents and purposes here. Land improvements are things like pools, decks, sheds, fences, things like that around your property. Now, this is typically depreciated over 15 years, but it's also eligible for bonus depreciation, which means that you could be front loading a large portion of this in the initial year or initial years that you own the property. Okay. Now, this is also going to be taxed at your ordinary income rates up to that 37%. And if there's a similarity between these two here, with Section 1245, if you depreciate that, that's always going to be subject to those ordinary income tax rates. But Section 1250 is subject to ordinary tax rates when you accelerate depreciation using bonus depreciation or double declining balance, which we're not going to go into in today's video. But I did just want to mention that just in case anybody out here is watching it and was wondering, what about the double declining balance? So that's the two forms, 1245 and 1250, that's going to subject you to ordinary income tax rates up to 37%. Now we're going to move into the unrecaptured 1250 gain. Now, unrecaptured 1250 gain is from the actual annual depreciation of your property. So if you have a residential property, you're going to depreciate your property over 27 and a half years. If you have a commercial property, it's going to be depreciated over 39 years. And this is called straight line depreciation because it's exactly how it sounds. A little bit is depreciated each year that you own the property. This is going to be subject to a maximum recapture rate of 25%. All right. So this is depreciation recapture and depreciation recapture taxes. Now, the good news is there are ways to, before I get to that, let me just make it clear. You have to take depreciation. You cannot avoid depreciation recapture taxes by not taking depreciation, because the IRS, when you sell your property, will assess depreciation recapture taxes based on depreciation that you actually taken or could have taken. So you have to take depreciation. And in fact, you want to take depreciation because of the time value of money. You want, if it can help you save more money in taxes today, you want to be able to do that so you can take that dollar and use it to go and invest and make more money. And on top of that, you have inflation. So, basically the more depreciation you can take today, the better it is for you. Long story short, you have to take it. Now let's discuss ways that you can mitigate exposure. There's 2 or 3 ways. Let me get through on the first one. The first one is by using a 1031 exchange. So when you sell your rental property, if you use a 1031 exchange, you can defer the capital gains and depreciation recapture taxes by investing the entire proceeds into a new property, which is known as the replacement property, which is typically a bigger or better property than you had before. And you're going to go ahead and mitigate your exposure to those taxes, and you're going to be able to continue to build your wealth. 1031 exchanges are very popular because it basically allows you to take the money you would have paid the IRS in taxes and put it towards your next property and continue to build your wealth. Okay. That's the first way. The second way is to buy a new property, all right, and run a cost segregation study on that new property. And that cost segregation study is going to break down the components of that property into 5, 7, 15, and 27 and a half or 39-year life, depending if it's residential or commercial. And that's going to allow you to accelerate depreciation on that property and use that depreciation expense to generate a loss, which is going to offset the gain in depreciation recapture on the sale of your original property. Now, it's important to note for this specific strategy to work, you have to buy the property in the same year that you sell the property, okay? So that is the second way. The third way is to buy the new property and use another cost segregation study to allocate certain components to like things like carpeting and appliances, things like that are not worth what they were when you originally bought the property. And this can actually help you mitigate exposure to that 1245, potentially 1250 recapture. But I must say that the first two are probably the most popular among these 3 strategies to mitigate it. So to summarize this video, depreciation recapture is a tax you have to pay on depreciation that you've taken over the time that you've owned your property. You have to take it or the IRS will assume you did and tax you anyway. Plus, you do want to take it because $1 today is worth more than $1 tomorrow, thanks to inflation and the time value of money. You want to be able to take that money today, reinvest it, earn a return. So it's not only do you have to take it, but it's in your best interest to take it. And then when you sell your property, there are ways to mitigate your exposure to these taxes. Okay, well, actually, let me back up in the summary. I forgot to break down the actual taxes, right? So Section 1245 and Section 1250 recapture from personal property and land improvements that you've used accelerated depreciation on are going to be subject to taxes at up to 37%. But the unrecaptured 1250 gain or the straight line depreciation will be subject to taxes only up to 25%. Okay. Now you can mitigate your exposure to the depreciation recapture as well as capital gains by using a 1031 exchange when you sell the property, or by buying another property, using another cost segregation study, generating another loss thanks to depreciation and offsetting the gain from the sale of your original property, as long as those 2 things took place in the same year. So do you have questions on depreciation recapture or depreciation in general? Go ahead and drop them into the comments to this video. Also, if you're thinking about selling a property or you're thinking about buying a property and want to use depreciation to help you reduce taxes, but you do have concerns about depreciation recapture, and you want someone to walk you through exactly how everything works so you can use these strategies to save significant amounts of money in taxes, I invite you to request a free 30-minute discovery call with our team. We love to learn more about your situation and how we can help. That link is also going to be in the description to this video. That's all for now, and I'll catch you in the next video. Hold up one second. Before we go, I had to let you know about the 4th way that you can mitigate exposure to depreciation recapture and capital gains at the same time, and that is by passing the properties to your heirs when you pass away. So rather than selling the property while you're alive, when you give it to your heirs, they will receive it at the fair market value at the date of your death, also known as a step up in basis. And this eliminates the capital gains and depreciation recapture taxes that you would have paid had you sold it while you're alive. So if you're in real estate for the long term, you're going to be using either a 1031 exchange, or you'll be buying your next property, running a cost segregation study on it, using the losses from that cost segregation study to offset the gain in depreciation recapture, or you'll be passing the property on to your heirs when you pass away. So that's it for this video. I'll catch you in the next one.